Good day, ladies and gentlemen. My name is Glenn Moore. I'm responsible for looking after the personal trust retirement funds. And I thought at the beginning of the year, let's have a look at how we performed last year and also take a perspective on the longer term performance numbers up to 10 years to see what we've been able to deliver for our retired clients over this period. So last year was a tricky year, tough year indeed, especially for offshore investors or for investors who had a substantial chunk of their assets offshore. The overseas equity markets declined by nearly 15% in rand terms, and offshore bonds by 10% in rand terms. The only place to hide was in cash offshore, which delivered a marginally positive return. South African markets held up relatively well in comparison, with the JSE All Share Index returning 3.5% and our bonds returning 4.2%, with cash the best performing asset in 2022. So this was triggered by the surprising increase in inflation, particularly in the USA, UK and Europe. That surprising increase in inflation resulted in central banks becoming very anxious and so tightening monetary policy aggressively in the first half or throughout 2022, and that resulted in declining bond yields and rising bond yields, which always results in declining equity performance. How does this compare to the 10-year numbers? And the 10-year numbers show us what we would expect, which is that equities do best over the longer term. So there you'll see the best performing asset class over 10 years, offshore equities at 13.5%, and local equity at just under 10%. Second best performers were bonds, which you would expect again. Longer term, to the term premium, you receive the term premium over cash. So offshore bonds and local bonds both returning around 7%, with cash returning around 5.5% over the 10-year period. So for some of us, particularly those of us who are close to the market, 2022 being a year in which you had a significant deviation from the norm, meant that we saw it at any rate as an opportunity time. So in the personal trust managed fund and in the conservative managed fund, we increased our offshore exposure during the course of 2022, with a lot of that money going into the offshore equities space. So offshore equities in the managed fund, for example, increased from around 13% of the portfolio to currently 20% of the portfolio. So we took advantage of that big sell-off in offshore equities. We also introduced 10-year government, US government bonds into the portfolio for the very first time in 10 years, with yields north of 4%. We thought that was an attractive entry point, and we were able to acquire some US 10-year bonds. So our offshore bond exposure also increased during the year. And we were also buyers of South African equity in that massive sell-off that took place around the middle of the year, where we were able to buy some additional South African equity exposure, which means that in both the conservative managed fund and the managed fund, for the first time in a very long time, both funds have, relative to benchmark, a full equity exposure and pretty full bond exposures if you add the local bonds and the offshore bonds together. So local bonds, we have a bigger exposure. We still continue to prefer to get 11% on a 10-year dated South African piece of paper relative to currently 3.5% on a dollar bond. So that seems to make sense to us to rather have the exposure in the South African bond market. But we have a healthy portion of US dollar cash, which perhaps in 2023 may not deliver what it did in 2022, because the dollar does feel as if it is relatively overvalued in comparison to other countries, but it remains our best insurance policy as asset managers, as asset allocators, in an uncertain environment. Whenever there's a significant event in the world which causes the markets to panic, the go-to place is the US dollar. The dollar always appreciates against all other currencies, and so therefore we keep that substantial US dollar cash holding in both portfolios as our hedge. So now to reflect a little bit on the performance that we've delivered over the last year, but then also over the last 10 years, I've broken up these performance numbers into little bite-sized chunks, just because too much data on one page you cannot possibly absorb. So if you have a look at that chart in front of you, you'll see there's a key at the bottom. If the personal trust number appears in purple, it means that we've delivered top decile performance relative to the sector. If it's in red, it's top quartile performance. If it's in green, it's top 1/3 performance. So the Personal Trust Conservative Managed Fund, we delivered top 1/3 performance at 1.94%, which was ahead of the peer group, but behind inflation. One must also realize that that 1 year performance came on the back of a performance number of about 14.5% for last year. So over the 2 years, we've delivered inflation beating returns. That's reflected in the 3-year performance, where we've delivered 8.95%, which is ahead of the peer group and inflation over that period, and it's top quartile performance. Over 5 years, top decile performance. Over 5 years, top quartile performance, ahead of the peer group and ahead of inflation. And over 10 years, top decile performance. So there was the top 10% of funds in that group, relative to the peer group of 6.95 and inflation of 5.19. So over the longer period, you'll see we've achieved our objective of beating inflation for our retired clients, which is our primary objective. In the Personal Trust Managed Fund, also a tough year, 0.78%, top third, ahead of the peer group though, which was negative, and behind inflation. That Personal Trust Managed performance of 0.78 comes on the back of last year's return, which was 18.5% for the year. So over the 2 years, we're ahead of inflation, which is reflected in those 3-year numbers, where we did deliver 10.2%, top quartile performance ahead of peer group and inflation. Over 5 years, 6.75% ahead of peer group and inflation. And over 10 years, 9.29%, top decile, ahead of peer group and ahead of inflation. The Personal Trust Prudent Fund, which is our multi-managed fund, had a very good year last year. 2 of the fund managers that are part of that fund, Alan Gray and Aylett, had excellent years. Deep value managers benefited tremendously during the course of the last 12 months relative to others. So that delivered 2.2%, top quartile performance ahead of peer group, but behind inflation. Over 3 years, we've done 9.75, which is ahead of peer group and ahead of inflation. Over 5 years, 7.03, ahead of peer group and ahead of inflation. And over 10 years, top third performance, ahead of peer group and ahead of inflation. We realize that historic performance is no guide to future performance. We also realize that we're only as good as our last game, and so we continue to endeavor to deliver inflation-beating performance for our clients. And we're hopeful that in 2023, we will have a better year than last year. Certainly January started off with a tremendous bang. The local market looks like it'll end up over 10% for January. Overseas markets up over 7%. So getting fully invested during the course of the last year is looking like it's right at the moment, but again, it's only at the moment. And bonds have also had a tremendous first month of the year. So if you have a look at the website and have a look at the fact sheet for the end of January, when it comes out, I think you'll see some very pleasing performance numbers. All of the very best for 2023, and we'll see you again sometime in March. Cheerio for now.